Hi, this is Blair Thomas with your Mortgage Market Minute. I hope you're doing well today. We've been talking about loan application. What do loan officers look at? And basically 4 areas: credit qualifying, income stability, asset affordability, and of course, collateral. We talked about credit recently. We talked about what a credit report, how the scores come in, that there's 13 different algorithms. But I want to talk about trade lines. There are only 2 types of trade lines on any credit report. They're either an installment trade line, meaning you have a flat agreed upon payment, like an auto loan, and you agree to pay $285 a month. And all they don't look at the amount, they look at whether you paid it on time or not. That's it. That's all they look at in an installment. You could be 30 days late, 60, 90 days, but that's the evaluation on that trade line. Revolving debt, another type of trade line, is different. It looks at a ratio. So you have a credit card and you have $1,000 limit on that card. You owe $625. You have a ratio of 62.5% on that card. Now, whether you're paid on time, let's say you pay the minimums every month, you're on time with your payment, you're not late at all, you're thinking everything's good, right? I would. Not an issue, but your scores are low for the reason that they turn this trade line into a ratio. And whether you're on time or not with your payment, that ratio is heavy laden toward over 50%, and it will negatively impact your scores. They don't tell you this. They don't make you aware of it. You could be paying on time, and of course you have it at 85, 90%, or even 60%. And you're still having negative impact to your scores. This is why they consider a card 50% of the high credit limit maxed out, and that negatively impacts your score even though you paid on time. We want to keep that card at 25% or less. 30% generally will not hurt you, but 25% is guaranteed to be a positive influence on your credit score. So let's try to keep those credit card revolving debt ratios below 25%. So I hope this helps you out. Now, there is one little trick you can do with a revolving debt. If you have a 1,000 card limit, you're sitting at around $450 owed on that card. You're below 50%. 25 to 50 is neutral. But what would happen if once a year you ask for a credit increase and all of a sudden you get an increase to $3,000 and you still own $450? That ratio is better for you. It becomes a positive for you. So you can attack this problem in 2 different ways. Request an increase in credit limit. The worst they can do is say no, but the best is they give you a higher limit. That helps with your ratios. Or 2, keep those ratios below 25%. I hope you keep them at 0, but I understand, and sometimes we have to leave some debt on there and let it finance over. We want to try to bring those down. We don't want them above 50%. So I hope this helps you. Hope you have a great Merry Christmas and Thanksgiving. God bless.